Now, Europe's central bank is seen keeping its benchmark interest rate at 1%. The main focus will be President Jean-Claude Trichet's comments about whether the European Union's recession is coming to an end. So for some perspective, let's bring in Julian Callow now. He is Chief European Economist at Barclays Capital in London. Good morning, Julian. Most people will be focusing on Trichet's comments about the recession. What do you expect to hear from him?
I think that fundamentally the ECB's assessment is not going to be so much changed at today's press conference. For sure, the staff projections which come out quarterly and which will also be unveiled during the press conference will, I think, have some upwards revision to the GDP profile. And in particular, I think the Eurozone staff will no longer be looking for GDP to be contracting during the second half of this year. So there will be some upwards revisions to GDP projections, but nothing too much. Potentially a slight upwards revision as well to the inflation, the HICP projection for next year, reflecting higher oil prices compared with 3 months ago. But in terms of the overall assessment that the Governing Council then make, I think it will be very similar to before. The risk assessment will be broadly similar to last month. The ECB will continue to say that it thinks the current stance of monetary policy is appropriate. I do think a little bit that officials went off to Jackson Hole and they may not have been feeling that optimistic before they went, but certainly I think when they came back, the general tone of comments we've been getting still seems to be really quite apprehensive, very cautious.
Right. How much of that do you think is priced into the market, this sense that there will be some revisions upwards to GDP?
I think that the ECB has been tending a little bit to lag behind the market estimates. For example, we think that the staff projection for real GDP in the Eurozone next year will be revised from minus 0.3% to around plus 0.8%. But our own forecast for next year, for example, is plus 1.5%. Now, we may be at the high end of the consensus, but I think the markets really have been buying into this idea that there will be a recovery, but still really quite a weak recovery in the Eurozone economy.
Okay, now Bloomberg's survey of economists shows that the ECB will not raise rates before the third quarter of 2010. You are not looking for tightening until 2011. Why are you more dovish?
Well, the basic reason is because the ECB follows the Fed. We're not looking for the Fed to be raising rates until 2011 in Q2. The ECB tends to lag significantly behind the Fed, and certainly our own estimate of the ECB's reaction function would say that it's not going to have sufficient grounds in terms of its inflation perspectives and growth perspectives, and given the amount of slack in the economy, to actually justify raising the main policy rate until very late in 2011. That said, there is going to be a kind of closet tightening, I think, unveiling during the course of next year, because the main policy rate is, of course, what everybody tends to focus on. But in the markets, what really matters is the overnight interest rate, the EONIA rate. That's the equivalent of the effective Fed funds rate. And that is trading at 0.35.
Okay, thank you for your thoughts. Julian Callow, Chief European Economist at Barclays Capital in London.